19.3 Capital and Natural Resource Market. This chapter covers three groups of factor markets: capital renter markets, land rental markets, non renewable natural resource markets, the demand for oil, the supply of oil, the equilibrium price of oil. The last one is the Hotelling principle. The markets for capital and land can be understood by using the same basic ideas as studying a competitive labor market. But markets for non renewable natural resources are different. We'll now examine three groups of factor markets: capital rental markets, land rental markets, non renewable natural resource markets. Capital renter markets. Economists use the term capital to refer to the stock of equipment and structures used for production. That is, the economy's capital represents the accumulation of goods produced in the past that are being used in the present to produce new goods and services. For our apple farm, the capital stock includes the ladder used to climb the trees, the trucks used to transport the apples, the buildings used to store the apples, and even the trees themselves. We need to distinguish between two prices: the purchase price and the rental price. The purchase price of land or capital is the price a person pays to own that factor of production indefinitely. The rental price is the price a person pays to use that factor for a limited period of time. So it is important to keep this distinction in mind because, as we will see, these prices are determined by somewhat different economic forces. The demand for capital is derived from the value of marginal product of capital. Profit maximizing firms hire the quantity of capital services that makes the value of marginal product of capital equal to the rental rate of capital. The lower the rental rate of capital, other things remaining the same, the greater is the quantity of capital demanded. The supply of capital responds in the opposite way to the rental rate. The higher the rental rate, other things remaining the same, the greater is the quantity of capital supplied. The equilibrium rental rate makes the quantity of capital demanded equal to the quantity supplied. Figure illustrates the rental market for tower cranes, capital used to construct high-rise buildings. The value of marginal product and the demand curve is VMP is equal to D. The supply curve is S. The equilibrium rate is $1,000 per day and 100 tower cranes are rented. Rent versus buy decision. The decision to obtain capital services in the rental market rather than buy capital and rent it implicitly is made to minimize cost. The firm compares the cost of explicitly renting the capital and the cost of buying and implicitly renting it. This decision is the same as the household makes in deciding whether to rent or buy a home. To make a rent versus buy decision, a firm must compare cost incurred in the present with a stream of rental cost incurred over some future period. If the present value of the future rental payments of an item of capital equipment exceeds the cost of buying the capital, the firm will buy the equipment. If the present value of the future rental payments of an item of capital equipment is less than the cost of buying the capital, the firm will rent or lease the equipment. Land rental markets. The demand for land is based on the same factors as the demand for labor and the demand for capital, the value of the marginal product of land. The profit maximizing firm rent the quantity of land at which the value of marginal product of land is equal to the rental rate of land. The lower the rental rate, the other things remaining the same, the greater is the quantity of land demanded. But the supply of land is special. Its quantity is fixed, so the quantity supplied cannot be changed by people's decision. The supply of each particular block of land is perfectly inelastic. The equilibrium rental rate makes the quantity of land demanded equal to the quantity available. Figure illustrates the market for a 10-acre block of land on 42nd Street in New York City. The quantity supply is fixed and the supply curve is S. The value of marginal product and the demand curve is VMP is equal to D. The equilibrium rental rate is $1,000 an acre per day. A change in the demand for land changes the equilibrium rental rate but leaves the quantity unchanged. The greater the demand, the higher is the rent. Demand determines the rental rate. The rental rate for an acre of land in Manhattan is greater than that for an acre of farmland in Idaho because the value of marginal product and the demand for the land is greater in Manhattan than in Idaho. The price of a Big Mac at McDonald's on Fifth Avenue is higher than in downtown Boise, Idaho, but not because the rental rate on land in New York is higher. The rental rate on land is higher in New York because there is greater demand for Big Macs, the most other things. In New York makes the demand for land greater in New York than in Boise. Non-renewable natural resource market. The non renewable natural resources are oil, gas, and coal. Burning one of these fuels converts it to energy and other byproducts, and the used resource cannot be reused. The natural resources that we use to make metals are also non renewable, but they can be used again at some cost by recycling them. Oil, gas, and coal are traded in global commodity markets. The price of a given grade of crude oil is the same in New York, London, and Singapore. Traders linked by telephone and the internet operate these markets around the clock every day of the year. Demand and supply determine the prices and the quantities traded in these commodity markets. We'll look at the influences on demand and supply by considering the global market for crude oil. The demand for oil. The two key influences in the demand for oil are the value of marginal product of oil, the expected future price of oil. The value of marginal product of oil is the fundamental influence on demand. It works in exactly the same way for the non renewable resources it does for any other factor of production. The greater the quantity of oil used, the smaller is the value of marginal product of oil. Diminishing value of marginal product makes the demand curve slope downward. The lower the price, the greater is the quantity demanded. The higher the expected future price of oil, the greater is the present demand for oil. The expected future price is a speculative influence on demand. Oil in the ground and oil in storage tanks are inventories that can be held or sold. A trader might plan to buy oil to hold now and to sell it later for the profit. Instead of buying oil to hold and sell later, the trader could buy a bond and earn interest. The interest foregone is the opportunity cost of holding the oil. If the price of oil is expected to rise by a bigger percentage than the interest rate, a trader will hold oil and incur the opportunity cost. In this case, the return from holding oil exceeds the return from holding bonds. The supply of oil. The three key influences on the supply of oil are the known oil reserves, the scale of current oil production facilities, the expected future price of oil. Known oil reserves are the oil that has been discovered and can be extracted with today's technology. This quantity increases over time because advances in technology enable ever less accessible sources to be discovered. The greater the size of known reserves, the greater is the supply of oil. But this influence on supply is small and indirect. It operates by changing the expected distant future price of oil. Even a major new discovery of oil would have a negligible effect on current supply of oil. The scale of current oil production facilities. It is a fundamental influence on the supply of oil. Producing oil is like any production activity. It is subject to increasing marginal cost. The increasing marginal cost of extracting oil means that the supply curve of oil slopes upward. The higher the price of oil, the greater is the quantity supplied. When new oil wells are sunk and when new faster pumps are installed, the supply of oil increases. When existing wells run dry, the supply of oil decreases. Over time, the factors that increase supply are more powerful than those that decrease supply, so changes in the fundamental influence increase the supply of oil. Speculative forces based on expectations about the future price also influence the supply of oil. The higher the expected future price of oil, the smaller is the present supply of oil. A trader with an oil inventory might plan to sell now or to hold and sell later. You have seen that interest foregone is the opportunity cost of holding the oil. If the price of oil is expected to rise by a bigger percentage than the interest rate, it is profitable to incur the opportunity cost of holding oil rather than selling it immediately. The equilibrium price of oil. The demand for oil and the supply of oil determine the equilibrium price and quantity traded. Figure illustrates the market equilibrium. The value of marginal product of oil VMP is a fundamental determinant of demand and the marginal cost of extraction MC is a fundamental determinant of supply. Together they determine the market fundamental price. If expectations about the future price are also based on fundamentals, the equilibrium price is the market fundamental price. But if expectations about the future price of oil depart from what the market fundamentals imply, speculation can drive a wedge between the equilibrium price and the market fundamental price. The Hotelling Principle. The Harold Hotelling, an economist at Columbia University, had an incredible idea. Traders expect the price of a non renewable natural resource to rise at a rate equal to the interest rate. We call this idea the Hotling principle. The interest rate is the opportunity cost of holding an oil inventory. If the price of oil is expected to rise at a rate that exceeds the interest rate, it is profitable to hold a bigger inventory. Demand increases, supply decreases, and the price rises. If the interest rate exceeds the rate at which the price of oil is expected to rise, it is not profitable to hold an oil inventory. Demand decreases, supply increases, and the price falls. But if the price of oil is expected to rise at a rate equal to the interest rate, holding the inventory of oil is just as good as holding bonds. Demand and supply don't change, and the price change. Only when the price of oil is expected to rise at a rate equal to the interest rate is the price at its equilibrium.